Hello and welcome to the show where I get to go nice and low in the ground. Get to dig to the roots. Here we go. Let's jump in. I love a little improv singing. So pardon the horrid tones. But all right, today we're going to journey through the 4 levers of real estate investing. And if you're here because, oops, I accidentally ended up on this show. I thought it was about general real estate. Stay tuned. You need to understand this. If you are just a person that has only bought or sold a personal residence, or maybe you're a current renter who has not yet bought a home, but you've been thinking about it, I want you to understand these 4 things. And if you are a real estate investor, celebrate with me in these 4 things. Here are the 4 levers that get to be pulled of real estate investing. The first, are you ready for it? Is principal paydown. And I'm going to tell you the 4 levers. I said lovers. It's the 4 levers that we investors are lovers of. And if you don't use a loan to buy a house, then you don't participate in all of these levers. But we'll save that for later. The first is principal paydown. So you're going to buy a property. Let's say it's the $150,000 property that I'm sitting outside of right now. And you're going to buy that house using some kind of loan. Let's say a 20% down conventional loan. You buy that house, maybe you live in it for a number of years, and then you move out and you lease it out. So on that property that you bought with an 80% loan to value loan, you have principal and interest payment due every month. You probably also have a tax and insurance payment due every month. That's your PITI. And every month, the rent, if you bought it right, or if it works well as an investment property, that rent is going to come in and it's going to cover your principal, insurance, taxes, and interest. Flip my 2 eyes. That principal portion every month is what I want to hone in on the first point. That principal portion comes from the rent that the tenant paid. The tenant paid, and from that payment, you're paying principal. So that means that it's going to start really small at first if it's a 30-year loan, and it's going to start a little bit bigger if it's a 15-year loan. But either way, that principal portion of what the rent goes towards is not cash flow. It's not that bundle of money you get left over at the end of the month. That's another lever. It's not that. It's kind of like a forced savings account. It's like owning a stock when the stock goes up and they pay a dividend. This is the stock going up. The dividend is awesome, but the stock is also becoming more valuable. You're owning more of that asset. So this is another layer that doesn't exist in the stock world. You're owning more of the asset. The principal balance of the loan has been paid down. That's the first lever, is principal reduction. The second lever is asset appreciation. So the first one was about the amount of loan. So you bought it and it's worth this and your loan is here. So this is your equity. And so every principal payment takes your principal balance of your loan down, which increases your equity. Second lever is property appreciation. By and large, over time, thank you government and other factors, properties become more valuable. It's not a infallible, inalienable gospel truth kind of thing, but it's by and large, the trend is that properties gain value. That's called appreciation. So the second lever is, while your debt, your principal is being paid down, also the property is becoming more valuable, which again increases your equity. So first 2 levers, your debt pay down or your principal pay down and your property value appreciation. Those are 2 powerful levers. You also have a third lever of cash flow along the way. So you've got cash coming in that's above and beyond these 2 things. That's the hidden value of your appreciation, the forced savings account of your debt pay down. And you've got, after your principal, interest, taxes, and insurance have been paid for, your property management company has been paid, and then your maintenance account has been stuffed. At the end of it, ideally, you would have some cash flow left over. That's the dividend. So you own this portion of a stock, and the company pays you a dividend for owning it. You own this house, the house pays you for owning it and managing it and running it well. That's the key. No tenant, no cash flow. So That's the third level, is you're going to have some cash flow. And then, oh my goodness, as if the first three weren't enough, the fourth lever is tax advantaged. It is tax favored. So, why is it tax favored? Because the government wants you to do it. They want you to go out and be a good landlord and provide good quality housing to other people. That's what they want. And you know what the government does to what it wants? It incentivizes it. It's the same thing you and I do. It's the same thing we should be more honest about is, hey, let's incentivize ourselves to do what we know we need to do. The government is very generous to incentivize what they want. They want you to go buy, if you're a business owner, they want you to go do certain things. If you're a person that has a mind to own a property and then to let someone else live in it for a rent, they want you to be a good landlord. And part of being willing to provide good quality housing for other people is that there are tax benefits. And so one example of this is in my personal residence 2 years ago. We spent, we had a little leak, and the leak got bigger and bigger and bigger, and we ended up spending like $12,000 chasing a leak. It's my personal residence. It was not a tax deduction. That was $12,000 of earned money that went into a house, and the house was, again, livable afterwards, so it just restored it. That was completely just post-tax money. If that was a rental property, as happens pretty regularly in the property management world, then that $12,000 would be a repair on a business expense or a business. Therefore, it's a business expense. Therefore, that $12,000 is not taxed. It's a beautiful thing. Add to that the fact that the IRS knows and acknowledges and therefore packages the benefit of the fact that the house becomes less valuable materially every year that it's owned. And so the IRS says, in essence, hey, we know that a single family house or a residential house, that everything in that house, the windows, the drywall, the driveway, the kitchen cabinets, the bathroom vanities, the toilets, the floors, the light fixtures and ceiling fans, all of it degrades over time. And so you're going to experience a bit of a loss with that functional depreciation or functional obsolescence or economic. So as these things degrade, there's a loss incurred. So the IRS says, all right, so how we'll figure this out is you take the value of a house. So this house that I'm outside of, we'll use as an example again. The house, the market value is $150,000. So that is comprising the house and the land it's on. The land does not have loss associated with it. It does not get less valuable over time. So the land doesn't depreciate, but the house does. So you say the house, the land is worth $20,000. That's about what you'd pay for a lot in this neighborhood. The house is worth, therefore, the balance, $130,000. The IRS would say, we're going to take that $130,000, we're going to split that up over 27 and a half years, and if it's a rental property, then you can claim $130,000 divided by 27.5, that much every year in depreciation loss. What that means functionally for you is that, think about lever number 3, the cash flow. It means, and I don't have my calculator in front of me, but let's say it works out such that 130,000 divided by 27.5 is 2,800. It means that this year, you'd be able to have $2,800 of income from level 3, that cash flow, that comes in that is directly covered by depreciation loss. Means that you could stuff $3,800 or $2,800 in your repairs and maintenance account, and it's completely covered by the depreciation loss. And so you've got a net zero taxable income there because the IRS says, hey, you're going to spend it eventually. You're going to replace those windows. You're going to fix the foundation. You're going to fix the sheetrock. So we'll give you this little tax break. So level number 4 is it's tax advantage. It's tax advantage both from the standpoint of, hey, if it's your personal residence, you're gonna flush $12,000 of earned taxed income fixing problems. If it's a rental property, it's going to be pre-tax. It's going to be a business expense. That's amazing. Thank you, IRS, for structuring that so in such a way that lightens the burdens to property ownership, and allows us to be good landlords. And so, but not just in that way, but also from the depreciation loss coverage, it means that you've got a cover that allows you to earn a certain amount of income completely tax-free. It's amazing. So when you add these 4 levers together, and they're called levers because they're things that are pulled with certain investments. You own a stock in a great company or a quality company that's not going to go away and it's going to become more valuable over time, then you've got an increasingly valuable asset that may throw off some dividends. That's wonderful. That's wonderful. If you own a house that becomes increasingly valuable over time, lever number 2, that's wonderful. It throws off a dividend. Level number 3 in the cash flow, that's wonderful. But you add to that it is tax favored. Number 4, it's tax favored and it's got some really cool treatment tax wise. And then number 1, that you can buy it using leverage. Means I can buy a $150,000 house for $30,000. Can't do this very easily with stocks. I don't even know that you can do it, but you can't do it with a lot of assets. I can't go buy $150,000 worth of gold with $30,000 worth of cash. You can buy $150,000 worth of real estate for $30,000 worth of cash, and then the other factors are also there. So you could also take $150,000 in cash and go buy a house. Like, that's absolutely fine. You're not using that lever, but that's fine. Some people like that. I would say that for me, leverage is a great tool, and there's more depth of the goodness of leverage that we can talk about and we'll talk about later. But regardless of how you ended up in this video, what I want you to walk away with is an understanding that real estate as an investment, whether that's something you got into because you're just buying investments, or whether, the people buying this house, for example, statistically, in 3 to 5 years, they will move from this house. If they bought it using what many people do when they're buying their first house or second house, they'll use a low down payment loan. Let's say they bought it using a 3.5% down FHA loan. When they move out 3 to 5 years later, statistically, it's likely that they'll be in a better economic position. It's likely that they won't need the cash that's locked in this house to buy their next house. So if that's you, if you're looking at buying that first house in the near future, or if maybe you've already bought a house or you just bought your second house, it doesn't really matter. What matters is this. If you understand that simply the choice to retain a house that could perform as a real estate investment can start pulling some of these levers for you, then you'll learn to start seeing value where it is and the net effect of that decision over time. Let's use this house again. It's a $150,000 house. Let's say you're going to buy it using a 3.5% down conventional loan. Math skills. So that's about it's about $5,000 something dollars. So let's just call it $5,000. So you buy it for $5,000. You've got some closing costs. So it's going to be about, $8,000, $9,000. So for $9,000, you buy the house. And then in a couple of years, you go and it's time to buy your next one. And if you don't understand that that house can be a powerful investment for you, then your temptation is going to go, hey, look, it's up 7%. And then you're going to pay an agent, which I'm an agent, no disrespect here. You're going to pay an agent. You're going to sell your house. You're going to take your 7% equity or market appreciation that you've gained. You're going to spend 6 of it paying for the agent, and you're going to be basically a break even. Versus if you own that, then your $9,000 you put in the house in 30 years is going to be worth, statistically, probably something like $200,000. $9,000 and then $200,000 is magic. And it takes patience, and it takes determination, and it takes focus. But if you can turn $9,000 into $200,000 in 30 years, do it every time. In fact, do it a lot. Put $9,000 and then move in 3 years into another house that you buy for $9,000. And then keep doing it as often as you can bear it, and just collect houses. And in the long run, it's going to be great. So keep on, build the vision, and stick to it. Bless you guys.